Dubai is paying $127 per ounce for physical silver right now, while COMEX is showing $73. That's not a premium. That's a completely different reality. Now, here's what nobody's connecting. China just banned silver oxide exports. The same week, registered COMEX inventory dropped to levels we haven't seen since 2016, and March delivery demands are stacking like dominoes. But the real question isn't whether COMEX can deliver. The question is, what happens to your dollar when the world realizes the price you're seeing isn't the price that matters anymore? Welcome to Currency Archive. If you've been watching markets long enough to remember when a handshake meant something, then you already know why you're here. Go ahead and click that subscribe button, because what we're about to show you won't be on the evening news. And drop a comment below. Tell us what state you're watching from, because this affects every zip code differently. On February 10th, 2025, a businessman in Dubai walked into a precious metals dealer and purchased physical silver at $127 per ounce. That same day, a trader in New York bought a silver futures contract on the COMEX exchange at $73 per ounce. Both transactions were legitimate, both were documented, both claimed to represent the same commodity. But they represented two completely different realities. This is not a story about market volatility. This is not about premiums or supply chain disruptions. This is about something far more significant. When the same asset trades at a 74% price difference between two major financial centers, one of those prices is fiction. The question business leaders must answer is simple. Which one? For decades, commodity markets operated on a fundamental principle. Physical goods had physical prices. Paper contracts tracked those prices with minor variations based on delivery timing, storage costs, and regional differences. A 2% premium here, a 3% discount there. These were normal. These were explainable. These were temporary. A 74% gap is none of those things. The COMEX, or Commodity Exchange and Consortium, functions as the primary price discovery mechanism for silver in Western financial markets. When news reports mention the price of silver, they reference COMEX futures contracts. When mining companies hedge production, they use COMEX contracts. When institutional investors allocate capital to precious metals, they reference a COMEX pricing. But COMEX operates primarily as a paper market. The vast majority of contracts never result in physical delivery. Traders buy contracts, sell contracts, and settle the difference in cash. This system works efficiently when participants trust that physical delivery remains possible if needed. The price stays anchored to reality because everyone knows the contract can be converted to actual metal. That anchor is breaking. In Dubai, dealers cannot source sufficient physical silver at COMEX prices. They offer $127 per ounce because that reflects what they must pay to acquire actual bars from remaining suppliers. This is not speculation. This is not a sales tactic. This is the clearing price for physical metal in a market where buyers have cash and sellers have increasingly limited inventory. The business implications extend far beyond precious metals trading. Silver is not simply an investment asset. It is an industrial commodity embedded in solar panels, electronics, medical equipment, and defense systems. When physical silver prices diverge this dramatically from paper prices, every business that depends on silver procurement faces a critical decision. Do they lock in supply at physical market prices and accept significantly higher input costs? Or do they wait, hoping the gap closes, risking supply interruptions if physical availability deteriorates further? This divergence has historical precedents, and those precedents ended poorly. In 1968, the London gold pool collapsed when central banks could no longer supply physical gold at the official $35 per ounce price. The two-tier pricing system that emerged caused years of monetary instability. In January 2015, the Swiss National Bank abandoned its currency peg to the euro. Traders who trusted the official price discovered within minutes that the actual clearing price was 30% different. Businesses with currency exposure faced instant losses. The pattern repeats. Official prices diverge from physical reality. Institutions insist everything is normal. Then the gap closes violently in one direction. Currently, COMEX registered silver inventory sits at approximately 100 million ounces. This represents the metal officially designated as available for contract delivery. But open interest, the total number of outstanding contracts, represents claims on roughly 400 million ounces. If even 10% of contract holders demanded physical delivery instead of cash settlement, registered inventory would be insufficient. Historically, this has not mattered. Typically, 98% or more of COMEX contracts settle in cash. Traders do not want the physical metal. They want price exposure. But that 98% cash settlement rate depends on confidence that physical delivery remains available for the 2% who want it. What happens when that confidence erodes? The March 2025 contract expiration approaches. Delivery demands have been running higher than historical averages. Registered inventory continues declining, and physical prices in Eastern markets continue widening the gap with Western paper contracts. This creates a question that every business leader must consider. If major institutional players believed COMEX could reliably deliver physical silver, would they pay 74% premiums in Dubai? The answer reveals something uncomfortable. Smart money is already voting. They are paying drastically higher prices to secure physical metal outside the paper contract system. They are not waiting for the gap to close. They are not trusting the official price discovery mechanism. They are preparing for something the price charts do not yet reflect. This is not conspiracy. This is not fear-mongering. This is observable market behavior that contradicts official pricing. When observation contradicts official narrative, business survival depends on trusting observation. The price that most people see is not the price that matters, and that gap is widening. In December 2024, something unusual happened in the COMEX silver vaults. A single warehouse operator reclassified 32 million ounces of silver from eligible status to registered status. On paper, this instantly increased available delivery inventory by nearly 50%. The price barely moved. No trucks arrived. No new metal entered the facility. The same bars that sat in the same vault simply received a different label. 3 weeks later, those same bars were reclassified back to eligible status. The registered inventory dropped again. Still no trucks. Still no metal movement, just paperwork. This is how modern commodity markets manage scarcity without addressing scarcity. The COMEX system operates on a classification structure that most market participants do not fully understand. Silver stored in approved vaults exists in 2 categories. Eligible inventory represents metal stored in COMEX-approved facilities, but not currently designated for contract delivery. Registered inventory represents metal that owners have explicitly made available to satisfy delivery obligations. The critical detail: the same metal can switch between these categories through simple administrative action. A vault operator receives instruction from a metal owner. The owner says, "Make this registered." A warrant gets issued, the inventory count changes. The system shows more deliverable supply. But nothing physical has changed. The bars have not moved, new supply has not arrived. The actual available metal remains identical to what existed before the paperwork shuffle. This flexibility serves a purpose in normal market conditions. It allows metal owners to monetize their holdings by making them available for delivery while maintaining storage. It provides liquidity. It keeps the delivery mechanism functioning without requiring constant physical movement of heavy metal bars. But this same flexibility creates dangerous opacity during stress periods. On February 1st, 2025, COMEX registered silver inventory stood at 103 million ounces. By February 10th, it had dropped to 98 million ounces. Meanwhile, open interest representing claims on approximately 420 million ounces remained outstanding. The ratio of claims to available inventory reached 4.3 to 1. Industry analysts responded predictably. They explained that most contracts settle in cash. They noted that eligible inventory could be reclassified if needed. They pointed to decades of smooth functioning. They insisted the system contained adequate buffers. But they did not address the fundamental question: what happens when physical demand exceeds the statistical assumptions built into that system? The mathematics of fractional reserve commodity trading depend entirely on predictable settlement behavior. If 98% of contracts consistently settle in cash, then registered inventory only needs to cover the remaining 2%. The system works. Prices stay anchored. Delivery occurs when requested. This breaks down when settlement patterns change. In January 2025, COMEX silver contract delivery demands ran at 3.7% of open interest. This appears small, but it represents an 85% increase over typical patterns. If this trend continues or accelerates, the mathematical assumptions underpinning inventory adequacy become invalid. And there are specific reasons why settlement patterns might be changing. On January 15, 2025, China announced export restrictions on silver oxide and certain processed silver products. The official justification cited national security and technology protection. The practical effect removed a significant source of refined silver from Western markets. Chinese silver production, which represents roughly 18% of global refined output, became substantially less accessible to non-Chinese buyers. Simultaneously, industrial demand projections for 2025 showed continued acceleration. Solar panel manufacturing alone is expected to consume over 200 million ounces of silver this year. Electric vehicle production requires silver for critical components. Defense contractors have been stockpiling silver for electronics manufacturing amid geopolitical tensions. These demand pressures are not temporary, they are structural. Yet COMEX pricing does not reflect supply constraint. The futures curve shows minimal backwardation. Contract prices for December 2025 delivery trade only marginally higher than March 2025. This curve structure suggests markets expect ample supply availability throughout the year. Physical markets tell a different story entirely. In London, the London Bullion Market Association reported delivery delays extending to 6 to 8 weeks for large bar orders. Historically, such orders cleared within 10 to 14 days. In Singapore, vault operators noted unusual demand for allocated storage, where clients take direct ownership of specific bars rather than holding unallocated claims on pooled inventory. These are not the behaviors of a market with comfortable supply cushions. Here is where the warehouse magic becomes problematic. If physical tightness increases, vault operators can reclassify eligible inventory to registered status, creating the appearance of adequate supply. This temporarily calms markets, but it does not create new metal. It simply relabels existing metal. Eventually, if delivery demands persist, the eligible inventory gets depleted through reclassification. Then there's nothing left to relabel. The warehouse that appeared full reveals itself to be an accounting construct rather than a physical buffer. A businessman reviewing these dynamics faces an uncomfortable realization. The inventory numbers published daily by COMEX represent legal classifications, not physical availability. The metal exists, but whether it becomes available for delivery depends on decisions made by metal owners who face their own strategic considerations. If those owners believe physical silver will be worth substantially more in 3 months, why would they make it available for delivery today at current COMEX prices? They can keep it classified as eligible, wait for prices to rise, then either sell at higher levels or reclassify and deliver at more favorable terms. The system assumes rational economic actors will make metal available when prices justify it. But that assumption requires believing current prices accurately reflect supply-demand realities. When Dubai pays $120 and COMEX shows $73, that assumption becomes questionable. In classical economics, arbitrage opportunities disappear within minutes. When the same asset trades at different prices in different locations, traders buy low, sell high, and pocket the difference. This price correction happens automatically. It requires no regulation, no intervention, no committee meetings. Profit motive alone closes the gap, except when it does not. On February 11th, 2025, a commodity trading firm in London ran the numbers on a seemingly obvious trade. Buy silver on COMEX at $73 per ounce. Take physical delivery, ship it to Dubai, sell it at $127 per ounce. The spread offered a 74% gross profit before expenses. Shipping costs for 5,000 ounces of silver from New York to Dubai, approximately $2,400 or 48 cents per ounce. Insurance for the shipment, roughly $1,400 or 24 cents per ounce. Customs, handling, and vault fees, another $1 per ounce. Total logistics cost, less than $2 per ounce. The net profit should have been approximately $52 per ounce. On a 5,000 ounce shipment, that represents $260,000 in profit for a 6-week transaction cycle. The firm never executed the trade. The reason exposes something far more significant than a simple pricing anomaly. The reason reveals that the two prices exist in two separate systems that can no longer communicate efficiently. Here's what the London firm discovered during due diligence. First, taking physical delivery from COMEX requires submitting delivery intentions 3 business days before contract expiration. The firm would need to maintain margin requirements during this period. For 5,000 ounces, that means tying up approximately $73,000 in exchange required collateral, plus additional broker margins. These costs accumulate daily. Second, COMEX delivery occurs through warrant transfer, not immediate physical possession. The firm receives a warehouse receipt proving ownership of metal stored in an approved vault. Actually removing that metal from the vault and arranging international shipment requires coordinating with the vault operator, providing specific shipping instructions, and waiting for the vault's schedule to accommodate physical withdrawal. Current withdrawal waiting times from COMEX approved vaults, 12 to 18 business days. Third, once the metal ships internationally, it enters a different regulatory environment. Dubai Customs requires specific documentation proving the silver's origin, refining standards, and trade compliance. Any discrepancies in paperwork can delay clearance by weeks. The silver sits in bonded warehouses, accruing storage fees, while documentation gets verified. Fourth, and most critically, selling in Dubai requires finding a counterparty willing to pay $127 per ounce for silver that bears COMEX delivery documentation. Those counterparties exist, but they are not buying COMEX bars at premium prices because they want bars. They are buying because they cannot get metal through normal channels. Their normal channels are drying up for reasons that have nothing to do with COMEX. In late January 2025, 3 major Swiss refineries that typically process silver for Middle Eastern markets reported order backlogs extending 14 weeks. These refineries take various forms of silver, doré from mines, recycled industrial silver, and investment bars, then refine them to specific purity standards and cast them into regionally preferred formats. Middle Eastern buyers prefer 1 kilogram bars with specific refinery hallmarks. COMEX. Good delivery bars are 1,000 ounce rectangular bars meeting different specifications. They are acceptable, but not preferred. More importantly, they signal that the buyer could not source preferred formats through traditional refinery channels. This creates a negotiation dynamic. The Dubai buyer knows the London firm is executing an arbitrage trade. The buyer knows similar spreads exist elsewhere. The buyer has leverage to negotiate the premium downward. The 120 sell-in price applies when buyers desperately need metal immediately. For a known arbitrage trader willing to negotiate, the price might be $115 or $105, or whatever level still makes the trade worthwhile while acknowledging the buyer's alternatives. Suddenly, the $52 per ounce profit shrinks considerably. But the complications extend beyond logistics and negotiation. The London firm must also consider counterparty risk across jurisdictions. Payment for physical silver in Dubai typically occurs through wire transfer after delivery verification. If the buyer disputes quality, claims documentation irregularities, or simply delays payment, the firm has limited legal recourse. International commodity litigation is expensive, slow, and unpredictable. Then there's the currency consideration. The 127 Dubai price is quoted in US dollars, but settlement might occur in dirhams, euros, or even yuan, depending on the buyer. Currency conversion adds another layer of execution risk and potential slippage. Most significantly, there is timing risk. The entire arbitrage thesis assumes the price spread persists during the 6 to 8 week execution window. But what if COMEX prices rise during that period? What if Dubai prices fall? What if the gap closes not through convergence, but through COMEX rallying to meet physical markets? The firm would be locked into a long position with leveraged exposure, watching their anticipated profit evaporate. These are not theoretical concerns. In late 2024, several trading firms attempted similar arbitrage strategies with palladium when Russian supply disruptions created regional price disconnects. 2 firms successfully completed the trades. 3 others suffered significant losses when prices moved against them during execution. 1 firm faced a force majeure claim from their buyer and spent 4 months in arbitration. So the arbitrage goes untaken, not because it is unprofitable in theory, but because executing it in practice carries risks that overwhelm the apparent profit. And this is where the real warning emerges. When arbitrage opportunities persist despite offering enormous profits, markets are sending a signal. They are saying the 2 prices exist in different risk environments. They are saying conversion between those environments carries costs that do not appear on simple spreadsheets. They are saying the system is fragmenting. A silver bar in a COMEX vault and a silver bar in a Dubai vault are technically identical. Same purity, same weight, same elemental composition. But they are not functionally identical anymore. One exists in a paper-leveraged financial system where most participants want price exposure, not metal. The other exists in a physical settlement system where participants want metal, not price exposure. These systems used to be connected by arbitrage. That connection is breaking. When the bridge between paper and physical collapses, the paper price becomes just a number. It means nothing to the businessman who needs actual silver for manufacturing. It means nothing to the solar company that must deliver panels under fixed-price contracts. It means nothing to anyone operating in the real economy. The price everyone sees is not the price that matters. And the gap between them is no longer closable through normal market mechanisms. That is not a trading opportunity. That is a system failure in slow motion. Business implication: companies that waited see input costs decline. Companies that locked in high-priced supply face competitive disadvantages. Cash remains king. Conservative procurement strategies get rewarded. Scenario 2, the managed stalemate. Authorities allow the 2-tier pricing system to persist. COMEX continues functioning as a financial price discovery mechanism used primarily for paper trading and investment exposure. Physical markets operate separately with their own pricing structures based on actual supply-demand dynamics. New contract language emerges acknowledging this split. Suppliers begin quoting prices as COMEX reference plus physical premium rather than flat prices. The premium becomes the real negotiating point. Businesses adapt to this new normal by building premium volatility into their cost structures and passing it through to customers where possible. Industrial users develop direct relationships with refineries and mines, bypassing exchange-traded markets entirely for physical procurement. The COMEX price becomes increasingly irrelevant for actual metal transactions, functioning mainly as an index for financial derivatives. Timeline: this could stabilize over 3 to 6 months as new pricing conventions develop. Business implication: supply chain relationships become more valuable than financial hedging tools. Companies with direct metal sourcing capabilities gain competitive advantages. Smaller firms without such relationships face margin compression or supply interruptions. Business implication: companies that waited see input costs decline. Companies that locked in high-priced supply face competitive disadvantages. Cash remains king. Conservative procurement strategies get rewarded. Scenario 2, the managed stalemate. Authorities allow the 2-tier pricing system to persist. COMEX continues functioning as a financial price discovery mechanism used primarily for paper trading and investment exposure. Physical markets operate separately with their own pricing structures based on actual supply-demand dynamics. New contract language emerges acknowledging this split. Suppliers begin quoting prices as COMEX reference plus physical premium rather than flat prices. The premium becomes the real negotiating point. Businesses adapt to this new normal by building premium volatility into their cost structures and passing it through to customers where possible. Industrial users develop direct relationships with refineries and mines, bypassing exchange-traded markets entirely for physical procurement. The COMEX price becomes increasingly irrelevant for actual metal transactions, functioning mainly as an index for financial derivatives. Timeline? This could stabilize over 3 to 6 months as new pricing conventions develop. Business implication? Supply chain relationships become more valuable than financial hedging tools. Companies with direct metal sourcing capabilities gain competitive advantages. Smaller firms without such relationships face margin compression or supply interruptions. Physical delivery demands exceed registered inventory capacity despite reclassification efforts. COMEX invokes force majeure provisions, suspending physical delivery temporarily. Contracts get settled in cash at prices determined by emergency procedures. Legal disputes follow. The event triggers broader reassessment of commodity exchange reliability. Industrial users accelerate movement away from exchange-traded procurement. Investment demand shifts toward physical allocated storage rather than futures exposure. Trust in paper commodity markets suffers lasting damage. Prices spike violently in physical markets as participants rush to secure supply outside compromised exchange systems. The dollar implications extend beyond silver into questions about broader commodity price stability and currency reliability. Timeline. If this occurs, the acute phase could unfold over 2 to 4 weeks, with aftermath effects lasting months or years. Business implication. Companies dependent on just-in-time silver delivery face production shutdowns. Currency hedging strategies require complete revision. Inventory holding becomes strategic necessity rather than inefficient capital allocation. These scenarios are not predictions. They are frameworks for decision-making under uncertainty. The procurement manager mentioned earlier cannot wait to see which scenario unfolds. His production schedule does not pause while markets resolve structural tensions. He must decide now, with incomplete information, facing costs that did not exist in his budget. This is the real impact of market fragmentation. It forces operational decisions based on unreliable price signals. Here is what businesses can monitor to assess which scenario is developing. Weekly registered inventory changes at COMEX, not just the absolute numbers, but the pattern. Steady declines suggest scenario 3 risk. Stable levels suggest scenario 1. Intervention is working. Wild fluctuations suggest scenario 2, stalemate is emerging. Delivery intention data released by the exchange. If the percentage of contracts demanding physical delivery continues rising above historical 2 to 3% norms, stress is building. If it normalizes back toward typical levels, the system is stabilizing. Physical premium levels in London, Singapore, and Zurich, not just Dubai. If premiums are widening across multiple geographic markets, the issue is global supply constraint. If Dubai remains an outlier, it may be regional factors rather than systemic breakdown. Refinery lead times for custom orders. If major refineries continue quoting 12, 16-week delivery windows, physical tightness is real. If lead times compress back toward 4 or 6 weeks, supply is loosening. Industrial user behavior visible through trade publications and supplier communications. When manufacturers start publicly discussing silver procurement challenges, voluntary inventory building is occurring. That behavior accelerates supply tightness regardless of underlying fundamentals. For businesses with silver exposure, several actions reduce vulnerability regardless of which scenario unfolds. Review all commodity-linked contracts for force majeure language and price adjustment clauses. Understand what happens if suppliers cannot deliver at agreed prices. Establish direct communication with multiple suppliers across different geographic regions. Redundancy matters when primary channels become unreliable. Calculate the cost of carrying extra inventory versus the cost of production shutdown. For many businesses, holding an additional 60-90 days of silver supply costs less than a single week of halted production. Consider whether fixed-price customer contracts should include commodity price adjustment provisions for future negotiations. Current contract terms were written assuming stable, reliable commodity pricing. That assumption may no longer hold. This is not about predicting market crashes or betting on defaults. This is about recognizing when the information environment has degraded to where traditional planning tools no longer function reliably. When Dubai pays $127 and New York shows $73 for the same metal, at least one of those prices is providing false information. Business decisions made using false information produce business failures. The question is not whether COMEX will run out of silver. The question is, whether business leaders will recognize that the price they see is not the price that determines their ability to procure the materials they need. Some businesses are already answering that question. They're securing physical supply at premium prices because they understand that production continuity is worth more than cost optimization when supply reliability is uncertain. Others are waiting, hoping the gap closes, trusting that markets will normalize because markets always normalize. History suggests one of these approaches survives disruptions better than the other. The decision cannot wait until the situation clarifies. By the time clarity arrives, the decision has already been made through inaction. This is the strategic warning embedded in the COMEX Dubai price spread. It is not about trading profits. It is about recognizing when market structure is breaking and adjusting operational strategy before that breakdown creates irreversible consequences. The price that most people see is not the price that will determine business survival, and the gap between those two realities is widening daily.